Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 20th of September. I'm Daniel Lam, your host for the podcast. As a movie buff, I've started sending clips to the Hong Kong-China Asian Games chess chat group. I would use such clips to illustrate phenomena that the team may encounter in the tournament, how to deal with them, and how to encourage them. So the first one was from Rocky 1 in 1976, where the TV interviewer showed the underdog heavyweight title challenger, Rocky Balboa, practicing his punches in a slaughterhouse. Now, Apollo's trainer saw Rocky's determination and raised red flag to Apollo about the danger that Rocky may present, but the overconfident heavyweight champion brushed it off. Now, a most talked about red flag in finance is the inverted yield curve. Now, this is a term used to describe periods when long-term bond yields are lower than short-term ones, and is commonly used as an indicator of recession. In the last 4 US cycles, when the 10-year versus 2-year yield curve became inverted, a recession typically followed in the next 2 to 16 months. Now, in this cycle, the yield curve has been persistently inverted since July 2022, but the US economy is still running hot. Now, there are a couple of reasons why this cycle may be different, such as the COVID-19 stimulus handouts resulting in excess savings and help sustain prolonged period of spending, and corporate earnings have been strong, upholding business activities. However, we continue to believe that a US recession remains likely in 2024. The stimulus or surplus savings from the COVID-19 era appears to be running out of steam. Financial conditions have tightened, predominantly due to higher interest rates, and the negative effect of both is already visible in several leading economic indicators. So we believe odds favor a steeper, i.e. less inverted yield curve from here. The Fed has slightly reached the end of the hiking cycle, abating upside pressure on short-term yields. In addition, we expect the Fed to cut interest rate in 2024 in response to weaker economic growth. Our analysis of recession episodes since the 1980s shows that it has taken an average of 11 months for the yield curve to return to the positive territory after it bottoms, and the yield curve steepened across all recessions by an average of about 140 bips. So what should investors be doing there? Well, if you may get falling interest rates, then the value appears to be lying in the longer dated DMIG government bonds. So why is that? Well, because they're very high quality, and usually they do very well at the times of recessions, and you are able to lock in very attractive long-dated yields to protect your portfolio for the longer term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.